Today we got the JOLTS data, and the employment openings for the month totaled 10.72 million, well above the estimate of 9.85 million. Policymakers usually watch this JOLTS report closely for clues about the labor market, and the latest labor market numbers are unlikely to sway the government from approving what likely is the fourth consecutive 0.75 basis point increase this week. The data indicates that there are 1.9 job openings for every available worker out there. This disparity in supply and demand has helped fuel a wage increase in which employment cost index, another closely watched data point, is growing at about 5% annual pace. Another report we got today is the ISM Manufacturing Index, and it posted a 50.2 reading. This number represents the percent of companies reporting expansion for October. Now, 50.2 is slightly better than the Dow's estimate of 50. However, there is a 0.9 percentage point lower than September. Another good news from the ISM data is that the price index fell another 5.1 points to a 46.6 reading, indicating lessening of inflation pressures. Order backlogs declined, supplier deliveries fell, and employment edged higher. The Fed releases its rate decision Wednesday. Markets are pricing in a nearly 90% chance of a 75% point increase, while narrowly expecting another 0.5% point move in December. The Fed at their September meeting projected that they would need to raise the rate to at least 4.6% by early next year. Analysts expect the Fed to follow this week's 0.5 percentage point rate as the same increase in December. However, there's also some analysts, for example at Bank of America, Goldman Sachs, that they expect rate hikes in December to be 0.5% points. Economic data released since the Fed's September meeting have been mixed. While domestic demand has slowed and the housing market is entering a sharp downturn, the job market has remained strong and inflation pressures have stayed elevated. Recent earnings reports have shown strong consumer demand and pricing increasing. Officials will see 2 more months of economic reports before the mid-December meeting, including hiring and inflation. Some economists say that the Fed will have to raise the Fed fund rate higher than 4.6% next year because of the resilience of consumer spending and domestic demand. Strategists at FHN Financial expect the Fed to raise its policy rate to about 6% by next June. Many investors this year are eager to interpret signs of a less aggressive rate rise pace as a sign that a pause in the rate increase isn't far off, but a sustained market rally risks undoing the Fed's work of slowing down the economy. Okay, so let's talk about some earnings today. Let's talk about Pfizer. So, Pfizer had an adjusted EPS of 1.78 per share versus the 1.39 expected, and had a revenue of 22.6 billion versus the 21 expected. Pfizer's third quarter global revenue fell 6% to 22.6 billion as compared to the same period last year due to softening demand for its COVID vaccines internationally. However, these softer global COVID vaccine sales internationally were offset by a strong demand in the US, where revenue increased 83% year over year due to the rollout of the new Omicron. Pfizer had a net income of 8.6 billion for the third quarter, a 6% increase over the same quarter last year. Pfizer said that they plan to launch 90 new products for existing drugs in the next 18 months. Pfizer now expects earnings per share of $6.40 to $6.50 for the year, up from its previous forecast of $6.30 and $6.45. Pfizer raised its full-year sales guidance for its COVID vaccine to $34 billion this year, up $2 billion from the company's previous expectations. Next, let's talk about Airbnb. Airbnb actually had its biggest and most profitable quarter ever, and it beat both Wall Street profit and revenue expectations. The company saw an increase in nights and experiences booked across all regions, as cross-border travel rose along with return to urban travel. In the Asia Pacific region alone, the numbers surged 65% year over year due to COVID pandemic restrictions being eased. Airbnb also saw an increase in the active listings. Active listings rose about 15% in the third quarter as compared to a year. Third quarter gross bookings rose to 15.6 billion, up 31% year over year, beating analyst expectation of 15.37. Nights and experiences booked climbed to 99.7 million, up 25% year over year, but shy of the 100.68 million expectations by analysts. The average rate was $156 as compared to the $153.2 that analysts expected. Airbnb reported a net income of 1.2 billion compared to 834 billion in the year ago quarter. Revenue rose to 2.88 billion from 2.24 billion in the year ago period. Airbnb expects fourth quarter revenue of 1.8 billion to 1.88 billion, while analysts had forecast earnings of 20 cents a share on revenue of 1.87 billion. Now, seeing these really good earnings, we have to talk about this Wall Street Journal article where they're saying that the US households still have around $1.7 trillion in savings that they have accumulated through mid-2021. Businesses were also able to lock in lower borrowing costs as interest rates plumbed new lows in 2020 and 2021. While the housing market, among the most interest rate sensitive part of the economy, is entering a deep downturn, the rest of the economy is so far holding together. Consumer credit card balances are rising. Earning reports, like we just talked about, Coca-Cola, Netflix, Bank of America, Airbnb, all of them are doing amazing and also point to a strong consumer demand and pricing. Now, this is definitely not the earnings seasons that the Fed wanted to see. Moreover, the Commerce Department reported that consumer spending adjusted for inflation rose 0.3% in September from August, a pickup from prior months. To cool the US economy, we might require even higher interest rates. So all of this is just to say that there could definitely be more pain in the market. Recently, there was this analyst who shared that the bear market today is more like the one from 1973 as compared to the 2000 or 2008. In 2000 and 2008, the market dropped when yields fell, and in 1973, the market dropped when yields went higher. And this is an inflationary bear market. So from looking at this information, and looking at the earnings report and what the Fed has to say, it seems like there will be more pain in the market. I hope this video and this information was helpful to you, and I shall see you in the next one. Bye!